All right. So welcome everyone to the live credit scoring series webinar, where we're continuing with Raymond and Pravin. And the way this is going to run is I'm going to start off with a couple questions myself to Raymond and Pravin that we've collected from some of the MRMIA work group members as well. And because we have, kind of a smaller audience today, Alan, Jessica, Michelle, Monica, feel free to jump in after I ask my set of 2 or 3 questions here and ask Raymond and Pravin some of the questions that have been on your mind, model risk related questions to some of the credit scoring models you may be working on, validating, or have some concerns about. And I also have a broader list of questions I can bring out as necessary if we need to kind of pull this conversation forward. So let's get started with some brief introductions, and then I'll start my first question here. So Pravin, why don't you give yourself a quick introduction to everyone?
Thanks, Mark. Hello, everyone. I'm Pravin. Background-wise and actually by training, I've been involved in model risk management for about 14 years at Deloitte, where I headed the bank analytics practice in South Africa. Subsequent to that, I was at a large retail bank where I headed custom analytics. And I currently have a boutique analytics business called Analytics Engine, where we specialize in mostly credit modeling and machine learning and similar things. My passion is actually extracting value, business value from models. And that's me in a nutshell.
And Raymond, you may have to unmute.
Well, I'm muted now. So Ray Anderson, my primary claim to fame is having authored 2 books that make great doorstops. So if you kind of need that or paperweights, highly recommend them. So I spent 34 years with the Standard Bank of South Africa, of which about 19 were in the field of credit scoring. And since 2015, I've been doing work with the International Finance Corporation, mostly relating to small business lending in developing markets. Initially, mostly the Middle East, Africa, EMEA, but more recently in the Asia region.
Excellent. Excellent. So we'll get our first line of questions started on a common topic I think we'll all relate to, especially as we're meeting through Zoom here, the pandemic. And I think especially with the rise of the Delta variant, it's been on a lot of folks' minds, especially in the news recently. And so when we think about it in terms of kind of a credit scoring and modeling context, one of the questions that we're getting is, what is the impact of the pandemic on the credit scoring modeling process? And then a personal question that I had is, what are we going to do with that data? During that shock period, how should we treat it? Do we develop on it? Do we ignore it? Does it just get like siphoned off somewhere for special circumstances? How is the pandemic affecting credit scoring modeling? And then likewise, what are we going to do with that data moving forward?
Are you directing that to any particular one of us, or is it the first person that raises their hand?
Either one. So Raymond, why don't you get us started here?
Okay. I think we're still working our way through. It's not really that easy to give an answer, but for all intents and purposes, it's a lot of the data within the period you're probably going to have to discard because of all of the mitigating actions that were taken, the forbearance that was put in place, just how that impacted upon the data. I think a lot of people, I'm going through a project at the moment in the Philippines, and we're trying to look at this. My thought is to say, okay, You got the people that were lent to before. How well did they manage through the whole process? And granted, there's going to be the models are going to be heavily affected, and their validity may be a bit suspect at the end of the day. But it's also possible that one could develop multiple models, to have one model that says, okay, how did people make it through? Would they be able to handle another type of shock? As on the whole, models that are developed during these shock periods that incorporate such shocks are better overall than those that are developed during benign periods. So if we've got the data, we should try to use it. But exactly how it's going to be used, one doesn't know as of yet. But we're fiddling.
Yeah.
Pravin?
If I can add, there's a few things that I think the period of stress, I'd like to call it. So if banks were well prepared, and how does one prepare for COVID? It would be a period of stress rather than a crisis. Couple of things I think that stand out for me. The first one is the world is moving in directions we didn't anticipate. So the first thing that I would focus on in the short term is what's going into your model, what's coming out of your model. There's not enough time to wait for the defaults to happen. Depending on your type of product, it's too long. So in the short term, the things I would be focusing on is almost population stability and outcome stability. What's going into my model, what's coming out of my model. The second thing that the crisis has highlighted, and I just said it's not a crisis, hopefully. The second thing that it's highlighted is that you want to acquire more data. And one of the things it hopefully highlighted is how easy you can or can't acquire more data. So if I give you a simple example.
By more, you mean other data sources?
Correct. A bigger variety of data, rather than more of the same. If I give you a simple thing, generally most banks assume that a chartered accountant who is working, I don't know, in the travel industry, if I use it in the COVID world, is likely to be retrenched because the travel industry is not doing very well at the moment. But because he's a chartered accountant, he's likely to get another job soon. So the question is, have we captured profession somewhere properly so that we know that someone working for an airline is actually a chartered accountant? And there's lots of other data sources like that. So I think one of the things that it has highlighted is our ability and willingness and cadence of collecting other data to help inform risk decisioning. The two other last points I'd like to make. One is just in terms of what do we do with the data? The first one is we use it to stress test our stress testing models. So what did our stress testing models actually tell us was going to happen and what is actually happening? Is our 1 in 100 year expected loss more or less than we're currently experiencing? And that's quite important. Then in terms of actually using the data, for me, as Ray said, there's a big problem in terms of how do you calibrate? What is the new normal? Because you're going to have to calibrate a new model every 6 months, probably in this environment. And so how are you actually going to decide? If you wait for permanent, good, stable data, I suspect it's going to be a few years. So the honest answer is you're going to have to make some judgment calls about what data is included and excluded. And I would definitely flag the data for archiving, but I would flag it for active research, for lack of something better, because this is an excellent data set together with a few previous financial crises that allows us to model the types of stresses that we should be thinking about. Not the stress itself, but the types of stresses we should be thinking about. And then the last one is just because we can't score accurately, and that's important, when we can rank, but we don't know the level of risk and we don't know whether the risk is going up or down in terms of height and tilt. Those two things are happening in your book. It also means we need to think about our risk appetite on customer segmentation. And so for me, the other thing that's quite important with this is increasing your customer segmentation so that in the example of the chartered accountant, you'll have a bigger risk appetite. And in the area of pilots, you probably have a smaller risk appetite, just to use poor examples.
So just this is a total aside, going off on a total tangent, but I was doing some reading the Tuscan bankers back in the 14th century. They got hit with a double whammy that could probably be called a 1 in 1,000 year occurrence. And the double whammy was the default of Edward III after he started going into the 100 Years' War against the French, the House of Valois, followed by the Black Death. And the combination of the two, well, by having lost all of that money, they didn't have the funds to recover appropriately from the Black Death later in the 14th century. So, but total aside, but we're talking about 1 in 100 year occurrences. You could have sort of a double whammy somehow that makes it even more extreme. And we can't even think about those things.
Mm-hmm. Yeah, and I think to kind of follow up on those data discussions here, one of the big things that's happening in people's minds is that there's a big assumption shift in how consumers are behaving pre-pandemic and post-pandemic. And so people still want to use that data for one reason or the other, but there's some very big assumptions we're making by using, pandemic data of people working in lockdown or the certain types of jobs and stimulus that happen versus what the world might look like post-lockdown. So do you guys have any comments on what kinds of assumptions are changing pre and post-pandemic, and what should we keep an eye out for in terms of how that might impact modeling behavior and model risk?
Well, I think there are certain trends, but a lot of these trends were in place already before the pandemic, and a big part of it relates to the use of technology. Right. The whole work from home thing. There was a desire previously to work from home, but it wasn't really possible. It was frowned upon by corporations because they thought that they wouldn't get as much out of it. Some corporations might still feel that way, especially where they are highly reliant upon collaborative work and canned water cooler meetings. And so you've also got things relating to the role of savings, at least in South Africa. One thing, those people who can save are saving more, trying to guard against sort of other shocks. And there are kind of changing purchasing patterns. I'm not able to speak to them that much, but well, some of it is making homes better. This expenditure on, if you're going to be working from home, let's make the home nicer because we're going to be spending more time on it, and so on and so on and so on. But a lot of this is coming through very slowly. It's not concrete. It's not necessarily going to show up in our numbers. The numbers that we're working with don't cover those types of factors. They're on the side. We might be aware of them, but it doesn't come through in the data that we're looking at unless we are developing models that are being used to analyze equities and different market movements and the prices of traded securities. Pravin, comment?
Yeah, so for me, a couple of things that are quite interesting about customers and understanding customers. The first one is, I think what we will see is a rise of more diversification in scoring techniques. So if you look at, particularly in the US, there's been a long history of using bureau scores as the primary measure for lending. And one of the things I do foresee is a lot more fintech type approaches in terms of alternate data to better understand customer behavior, because we are less interested in the long-term historical behavior of customers and are more concerned with the medium to short-term trajectory of those customers in a very volatile world, because we're not as sure that the information of 3 years ago We know it's still relevant, but we don't know how relevant. So one of the things I foresee is a lot more alternate scoring approaches. And one of the things we got to be careful of there is, and I often refer to it as beware the cookie monster. It's great to collect cookie data and tagging data and all kinds of other internet data. And the data governance starts becoming very important to act responsibly in terms of the data we use to collect and understand the customers. But the other part that goes with that is it's never been more important, in my opinion, to have the transaction account, to be the main banked owner of the customer. Because if you have the transaction account, you can see the spending patterns change. You can see the lifestyle change, assuming you're listening, on those transaction accounts. And so for me, it has never been more important to understand and to have the main banked information so that you can actually understand the customers. For those people who want to be a little bit more out there, the other thing that you can do is try and build some interesting measures if you're interested in the research, is to almost try and reverse engineer people's utility and risk appetite. It's something we looked at a few years ago. And when faced with a period of stress, some people will splurge and some people will become conservative. And it's actually a great time to try and profile your customers in terms of individual utility theory and risk appetite. But again, that's out there only for people who are doing relatively well and have the breathing space.
Just on the transaction account thing, we tend to be highly focused on banks. There are a lot of people out there that are trying to develop credit risk models who aren't really banks. They aren't necessarily offering transaction accounts. And especially in instances where you're looking at the lower end of the market, a lot of people are adopting things like mobile money and sort of stuff that's just booking off of cell phones. You don't necessarily have access to that. In Kenya, you've got Safaricom, they've got their own sort of money thing. And as a result, Safaricom has practically got a monopoly on transactional data for most of the population, because the banks tend to be focusing on the more affluent businesses. So one also has to think of other sources. If you cannot get things like mobile money data, then look for something that's, at least within a lot of the recent research, looking towards data that can be acquired off of cell phone usage, whether it be without being too invasive. Call logs that are the time and duration of calls or text messages, et cetera, et cetera, et cetera. One shouldn't limit oneself to just a few possibilities. But it also, that does depend upon what market you're in and what capacity you've got.
Mm-hmm. Mm-hmm. Yeah, let's.
I was wondering if I could sort of put a comment in here, because I think you're exactly right. I think models are going to have to observe a different kind of data or get fresh points of view to be able to analyze new behaviors. But we're still going to be stuck in the short term because these behaviors are still evolving. And there has to be some mechanism, and I'd be interested in your experience and comments on this, some mechanism of putting in, I suppose, preventative or anticipatory changes into models. Things you see that you can predict judgmentally or even start to look at some data trends, but you don't want your model to fall out of, to miss the behavioral switch. And yet it's a bit of a bet, it's a punt on which way things will jump. Do you have any comment on how wise that sort of tactic would be, and whether there's any good technique that would get you there?
If I can maybe jump
Pravin,
in.
do you want to take that one first? I've got a
sure.
comment.
Happy. So for me, I think there's a couple of things. I think definitely the behavior up. So the one thing we know for sure is volatility is going to be more pervasive. And so couple of things I think will happen more often. The first one is you'll be recalibrating your models more often. I think the days of recalibrating models annually every 2 years, every 3 years are gone. I see banks recalibrating their models on a monthly basis. Whether they choose to change to the new calibration will go through a governance process. But I would almost see you rerunning your scoring model monthly, just to see if any of the drivers pops up a different answer. I would see you continuously testing new parameters if you can source them, but that's not fast. The two other interesting things that I think you'd have to do and you can do in the short term. The first one is population stability. And population stability for me, the graph I like to see often is just a decile, a cumulative frequency distribution. What is the 100th percentile and the 0th percentile of values coming through my model? Because often on the standard statistical measures, they're heavily weighted by the middle 80%, and you make your losses on the 20% at the ends. And so I'm very interested in how the edges of your population are shifting. And so if you haven't already done that, start looking at just how the edges of your population are shifting. I would start looking at, again, the scores coming out and whether they're shifting or not shifting. Because often they won't be shifting as fast as the macroeconomics are shifting, or the perceptions of the macroeconomics, because again, the macroeconomics lag. The one big problem we have is that the actual PDs themselves take a long time to come through. And so you're going to have to make some judgmental risk appetite calls. And for me, risk appetite calls, especially judgmental ones, can be very expensive. You either lose market share or you take too much risk. And the way to minimize that risk is to micro-segment your portfolio. So I see a lot more micro-segmentation of portfolios because different customers behave differently, and either through geography or industry or demographic or education, you're going to have a different view of your customers. And so the more micro-segmentation you can do of your customer base, I think the better answers you're going to get.
I agree with the comment on the segmentation. What I would like to add in terms of the modeling aspect is try to keep it simple. And if you can't keep it simple, have simplicity as a backup. Also, sort of try to have models that potentially cover a long period of time and have, if you think of it, sort of policy rules are a form of a model that are, or at least those that are related to credit risk. And they were being developed over a long period of time. And we had an instance where the rules were in place and we started challenging the rules. And this was on a home loans portfolio. And it was agreed they took the rules out or changed them. And then the 2008 crisis hit. The comment that was made to me afterwards by one of the top guys was, those rules had been there for a reason, we made a mistake. So if you've got those policy rules, kind of keep them, reinforce them, try not to only challenge them in extreme circumstances, and sort of with the models, used to using sort of logistic regression. If you go into the more avant-garde models for a highly material model, highly material portfolio, at least have a basic generalized linear model as a backup. Anything further, Pravin?
Yeah, so the one other thing which I forgot to mention, which I think will start making a comeback, is actually focus groups, which sounds silly and sounds very outdated, but actually is phenomenally valuable. So assuming you've got a view of how you'd like to segment your portfolio, and I mean more than just age and income, once you've got clusters within your population, sometimes it's actually useful to just phone 20 of them and see how they're doing. It's amazing what people will actually tell you. And one of the things that we forget in data science is at the other end of that data is a person. And that person can tell you a lot more than a series of ones or zeros. And so I do see a lot of reality checks coming in, and where we actually just talk to our customers. We used to do it in branch. A lot less people are coming through to branch. But again, through our apps, through our emails, through actually just phoning people, and proactively, not just when they're in difficulty, just to check in on how they're doing, what's going well for them and what's not. I think there's a lot of insights to be gleaned. So I would definitely see a big comeback to actually talking to people, believe it or not, whether that's talking to them digitally or talking to them physically via a phone. I think there's a lot to be learned to supplement our own internal views, because our internal views invariably are biased.
Just this is I had an instance many years back where dealing with a lot of people that were sort of statisticians looking at a set of data, and they couldn't understand it because some of the values were totally out of kilter. And when we did a drill down, and it was brand values in South Africa, when we did a drill down, we found that the company names were Portuguese. And so the end conclusion was that the cases that were so far out of kilter, it was in a different currency where the exchange rate was 1,000 to 1. So it applies not just to speaking to customers. You can get a lot just by drilling deeper into the data and not just relying upon aggregate averages.
Absolutely. Did we have anyone else that wanted to chime in here?
I have a
Ellen,
question.
did that cover what you were asking?
It definitely did. I see Michelle has got her hand up.
Hi there. I don't know if you can see.
Hi, Michelle.
Hi. I don't
Hey.
know if that camera is not behaving. Hi, everybody.
Oh, damn.
Hi.
We'll get it back in a minute. So my question relates to looking at scoring, the use of scoring and data through the credit life cycle. So far, your comments seem to be directed towards the underwriting part of the credit life cycle. And when we work with clients, you know, we find there seems to be this like obsession with that and the underwriting models. But at the end of the day, to change the temperature in the bathtub, yes, you have to change what's coming out of the tap, but then you've got the rest of the bathtub that's a certain temperature. So, you know, we're looking at how to really up their game in the account management area, credit line changes, using those models to direct, you know, changes to the account management process, the collections process, et cetera. And kind of, you know, and it's in some cases, they've really tamped down underwriting, so they can be obsessed with the underwriting and the through the door and the, you know, those reports, as you rightly mentioned. But at the end of the day, if they've really decreased the volumes, then, you know, we want to make sure don't drop the ball in the rest of the life cycle. So I'm curious to hear kind of your comments on that underwriting phase. They track with what we are seeing and talking to customers? And thank you for the focus group piece, because we also, we do user personas with clients now, et cetera. But I'm just curious if you'll make some comments on the other pieces of the life cycle.
I'm happy to. Ray, are you happy? Can I jump in?
Please do.
Okay, perfect. So interestingly, I've done a bit of work in that space. So the most obvious one is just the normal behavioral scoring that banks do, which they use often for capital management, limit setting, portfolio quality monitoring, etc. So that's the most obvious application of behavioral scoring. Couple of things I would flag in behavioral scoring. We can see you now. Great. Couple of things I would flag in behavioral scoring. The first one is to just be careful of individual variables which become too strong. So I've seen some customers get really amazing genies, and when you dig into their scorecard, they have a lot of warning variables. So customers 49 days in arrears and provides a wonderful information value that is going to get to 90 days in arrears. So just be careful of warning variables in them. The other area that we've spent a bit of time on is just stability of outcomes. So customers, particularly those that mill, tend to be quite interesting. And by milling, I mean a customer who goes into and out of arrears or delinquency or default, as the case may be. And one of the things that we found very helpful in that space is creating a stable definition of default or cure. And a lot of the European regulators specifically require you to allow, for example, if a customer goes into default, to be fully performing for a period of 6 months to 12 months, depending on the nature of the product, before they deemed to come out of difficulty. And we found that by tweaking the definitions that way, we got much more stable calibrations of customers. Again, the segmentation is quite important. So restructured and distressed customers, again, modeled separately, gives you a lot of insights. The part that for me, I think a couple of other things that we've seen, a lot of the lower end, bottom of the pyramid type lenders, cash lenders, tend to also give a lot of weight to recency, not just aggregate delinquencies. So your recent payment history is in addition to your long-term payment history. There was one more thing I wanted to add to that, which just slipped my brain. Yes. So the other interesting use that we've done is in the collections space. We've tried to score customers in terms of their ability to rehabilitate or ultimately be written off. So in most accounting systems, whether it's CECL or IFRS 9, there's a time value of money which matters a lot. And the quicker you either collect or write off, the better. But at the same time, you can often collect more by offering some concessions to the right customers, and that's the important part. And so one of the things that we've done, interestingly, is a reasonable amount of modeling around customers who eventually are likely to get written off and likely to cure. And we found that to be quite interesting. The challenge is finding a stable definition of write-off, because it tends to vary with the economic cycle and affordability, strangely enough. I didn't say that out loud. But banks seem to change their write-off point based on what they can afford. And so finding a proxy which is earlier than write-off, but that is relatively stable. So you might find 12 months in arrears or less than a certain number of installments over a certain number of months, but getting those features engineered can add a lot of stability to your model. So it's not just about the statistical modeling, it's about common sense and feature engineering to create stable variables and stable proxies for real life.
So I think on the write-off, you can also find that the individuals who are managing the accounts are playing a role in just how quickly it's written off, and the personalities will, so some guys will be quicker than others, but you cannot necessarily get those personal factors into a scorecard. So another comment that I would add here is that we talk about behavioral scoring and collection scoring. It's also the behavioral scoring that we were doing was largely focused upon internal data. And there comes a point where you should also be looking outside of the organization. We were using it for doing sort of setting what was called confidential limits, and which was limit over and above the agreed limit that we would be willing to go up to. And it was heavily focused on the data from just the one account, from the transaction account, and then kind of moved over to on the entire customer. We're trying to figure out, well, how much we're going to lend across all products. But at no point was the bureau data brought into the equation. So one must also look outside, because he might be doing well with you, but sort of you've got the 40-year relationship, and the other guy doesn't. He's going to try to maintain the 40-year relationship while defaulting everywhere else.
The inverse of your last point, Ray, is something that we saw. It depends on whether your bureau in your territory does positive or negative data. You might find non-performing customers doing the opposite of you, of what you just mentioned, which is paying other people but not paying you. And again, you should be able to see that in your data. And the interesting thing there is to determine which customers to prioritize for collections. Obviously, the ones who have money, so that you can actually get decent recoveries. The one other piece that we did on the back of that was also some work around collateral. So looking at collateral realization optimization. So one of the things we did during the previous home loan crisis, we took a bank's workout process and actually built a simple roll rate model and just looked at the different channels that they use for workout, panel of estate agents, auctions, etc. And just looked at, if you made a 1 or 2% shift in your customer base in the right segments, you could actually, because you can't move the whole book, right? That's just not realistic. But you could prioritize 1 or 2 management actions that is likely, not guaranteed, likely to give you a big lift, because management in practice can't change their operations fast. They can deal 1 or 2 practical use cases. And so if you can help them to prioritize those 1 or 2 practical use cases, it can be very useful. And the one, sorry, I'm just on a roll, Raymond, before I forget the last point. I have no short-term memory to speak of, so I either say it or I forget it. The last one is, we also did an interesting project with a client to determine the best time of day to contact a customer, as well as the best number to contact the customer, if you have multiple numbers. That's it.
Okay, you're finished with your role.
Yes.
Okay, so with you finishing your role, I think I might have forgotten what I was going to say. Aha, what it was there was a guy called Sheshinov, I think his name was, who commented about the informed customer effect, where customers, if they are in stress situations, they will be in arrears on those accounts where it costs them the least or where there are the least consequences. So if the interest rate on one loan is lower on the other loan, and there aren't any default charges, then they will not pay that one, and sort of let it kind of rack up. So they will be juggling in a manner which is cost effective, even though they defaulted. Be cost effective for them. And I've actually found myself doing that myself. Well, actually, I haven't defaulted though. Maybe I have. I'll have to go back and look.
Did you have any follow-ups, Michelle, or?
Well, Raymond, just to comment on that, we actually use quite a bit of Joe Breeden stuff in our workshops with banks. And one of those is that the notion of the payment hierarchy, that people will pay things in a certain order and in each market. And to your point, Pravin, in micro segments, they'll have a different order that they'll pay. So for example, in the US, let's say your job is to clean hotel rooms. They won't even give you the job unless you can prove you have a car, because we don't have good public transportation. So for them, they would actually pay the car before they would pay anything else. And then these days, the credit cards, people are moving those up in the priority because they have all their auto pays hooked to it, et cetera. So, and I think going back to your original point at the beginning about the assumptions we used to have about the order in which people would pay things, I feel like you have to revisit all those assumptions. Because, you know, most banks have a sense of that, but I feel like post-pandemic, I feel like that is a big assumption that could change. And that's just an assumption. We can't always measure it, but it does drive a lot of our management actions, especially in account management and collections.
Yeah. There was a comment. So,
no, you go ahead first.
A long time ago, there was a comment made with the 2008 crisis. You cannot drive your house to work, and you know that's basically what it boiled down then. And the situation now with work from home, the car is less important. Sorry, carry on, Pravin.
Yeah, I was going to say, coming back to the earlier point I made about the importance of the transaction account. Where you do have the transaction account, you should be able to see what the customer is prioritizing. And that's why, again, it comes back to the importance of the transaction account. The important point to bear in mind is often though you may have the transaction accounts, the customer may have 2 or 3. But still, particularly if you've got the main bank where their salary gets paid into, you can probably tell a lot. I've previously spent a lot of time trying to understand customers.
Yes, absolutely. Alan, did you have something to add?
Yeah, I was going to ask a question or I was going to sort of expand a point which said that, you know, a lot of what I'm hearing here is very good practice. It's excellent thinking, stuff we should be doing. The message I was getting was that we should just be doing it quicker and more intelligently. But actually, Michelle's Michelle's point was changed my thought there, because you said yourself that we're having to change our assumptions about particular beliefs on, say, customer behavior and so on. And I'm just wondering, that's an important lesson. I think we need to hold on to that there are some assumptions now that are going to have to change, or we're going to have to shake some of our, the order of collateral or whatever assumptions that we had. Are there any other areas that are being shaken as much in this way? Are we going to emerge with essentially just a faster version of what we used to do with some changed assumptions, or is it going to be much more fundamental?
I hope it's more fundamental. And the reason I say I hope it's more fundamental, I think banks have been lazy. I think you can blame the fintechs for this, but and I do worry about the volatility of fintechs. I think some of them do present systemic risk. But I honestly think that to win with the customers, we have to go back to actually wanting to help the customer. And I think we've somewhere along the journey lost that. We've become businesses, which is a wonderful thing, right? I mean, I'm as capitalist as everyone else. But the important point is we've got to go back to focusing to wanting to help the customer. And I think if you get that right, you build systemic relationships with your customers, even if it's in the mass market. So I do hope we will do things quite differently. And I think to change is human. Society changes all the time. I mean, what we do now, it's actually interesting though. So the more we change, the more we stay the same. 20 years ago, you watched TV, then you watched a VCR, now you watch streaming cable, and you'll watch something else in future. People still need entertainment. People still need food. People still love their children. The fundamentals will never change. How we execute those fundamentals will change.
Yeah, Raymond, did you have anything to add, or?
No, I didn't. So I think kind of Pravin covered it.
Yeah, Michelle.
So many questions. Who let this lady in here?
Keep them coming.
Keep them coming.
So many questions. So my other question relates to a comment you made, Pravin, about doing modeling to predict the best time of day to call. I'm gonna give you a little bit of a hard time about that.
Yeah.
Right. Some of the banks who I would say are not being lazy are really working to adopt an omni-channel approach to talking to their customers, which is not easy. The systems don't talk to each other, blah, 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 right?
Yes.
But that is a much more complex modeling process because they're trying to figure out like best time of day to call, right? It's pretty straightforward in terms of a modeling process, right? You've got your data, you've got your outcome, like fine.
Thinking about the data is not.
Well, yeah, that's true. That's true. But I mean, as compared to the omni-channel where you're trying to pull data on, I sent a push alert to the app and I captured the time and date on that, or I used location data because they walked by a branch and I sent an alert versus I sent an email versus an SMS versus this versus that, and trying to pull, and it's not just one, like the time of day thing is I called or didn't call, had a time of day, didn't, right? But with the omni-channel, it could be a combination or the order of the things.
Yes.
Right. So we are, I feel like that's to your point if you're going to really go back to the customer, that to me feels like more of the right solution to get back to customers. But I haven't modeled something like that and I haven't seen them, but it does seem like it would be a challenge. I don't know if you've.
It would. So a couple of things. The first one is very few banks are omni-channel as opposed to multi-channel. And the difference being the channels talk to each other or don't. So that's the first important step in that one. When I say call the customer, I mean contact the customer. It's however you contact the customer. When you do contact the customer will either respond, and then there's degrees of response. The first one is he'll open the WhatsApp and he'll read it, or he won't. The second one is he'll respond or he won't. And so there's an entire value chain there. or a waterfall of steps, if I call it that. For me, I agree with you on everything you said. So I'm agreeing wildly. The first part, I think, is you've got to test it, right? So you've got to do response modeling across your channels. And when you eventually get to omni-channel, because I don't think many people are at omni-channel, there's almost journey analytics. So if you look at like sequential analytics, people don't respond on your first call, or they do, and then they stop. So one of the things that one of the banks did in Ireland during the mortgage crisis, you'd see a letter coming from the bank, you'd know it's a letter from the bank, you wouldn't open it. So one of the things they did was they put funny color letters to make it look like a Christmas card, and then people would at least open the letter. And that works for the first 2 weeks, right? And then customers know that the Christmas card in May is actually not from Santa Claus. So again, it keeps shifting. So for me, I think a couple of things that you said that's important. The first one is we mustn't forget the channels we have, because we do have multiple channels. The second one is we need to figure out how we interact with those channels. And do we have, coming back to the faster comment that Alan made, noted earlier, how do we integrate with those channels? And that's important. Interestingly, a lot of banks have a sales engine which already integrates. It's just the sales team and the credit team don't talk to each other. So that's quite important. And then what you want to do is do lots of A/B testing and lots of different types of campaigning, again, to different types of segments. So people are dynamic, behavior is dynamic. Your messaging and contacting of customers has to be dynamic. The important part not to lose sight of, though, is its effort and cost. So you're going to hit the low value items first, or the high value items first, sorry, the low effort items first. And the important point is that's going to be different for every bank and every customer segment. So you've got to use what you have. The important part is to get measurement in place, because without measurement, you don't know what's working. And very few banks are good at measurement. And then the second part is so once you've got decent measurement in place, is to look at creating your cadence of being able to talk to the customers without being annoying. That second part is quite important. There's a fine line between being insistent and being abusive or harassing.
Mm-hmm.
I think the one part that was underplayed there, you mentioned it, but it's underplayed, is the cost element. Because certain of the methodologies like phone calls can be very expensive, personal phone calls. Emails tend to be very cheap. So just how do you build the costs into these investments? It's not just it becomes practically an expected value calculation for each of the different approaches that are going to be used, where probability times cost times outcome, blah, 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 blah. You take all those things, you put them together and see which provides the greatest benefit.
Mm-hmm.
You mentioned you had lots of questions. You want to do the next one?
Yeah, I was gonna say we can continue on this topic. We got about 10 minutes left, and I'm okay to run long by another 10 or 15 minutes if we'd like to continue on this topic or change topics. I'm open to either one.
So I think kind of try to move on and cover as much as possible of what was put in, as opposed to sort of dwelling.
Okay. One of the we can kind of take it in two directions here. There's a lot of buzz around AI machine learning, or I can start asking about external versus internal builds.
I think go on the AI one first.
Okay.
Only because I have some relatively strong views where there is a trade-off between the complexity of the model and the materiality of the portfolio to which it is being applied. The more the money that's at risk, the more that you want to be able to understand it. So if you're doing credit models on a home loan portfolio, you'll probably want to use more traditional technique, but where you're doing marketing or collections, then the field is pretty well open to you in terms of what you can do. The greater the governance requirements, the greater the need for transparency. And I know a lot of people on the AI world are trying to get means in place to get it past the regulatory and governance hurdles. But you know, if you are going to use the AI, it's that case of have a simpler approach as a backup in case it's not working and it falls apart. Because when it doesn't work, you won't easily know why it's not working.
Mm-hmm.
Pravin?
So I'm open. For me, it's a tool, right? So it depends what you're solving. I'm a big fan of machine learning, and for the main reason that very little in the world is normal. So, and when I say normal, I mean the statistical distribution. And so often in statistics, we're assuming distributions which don't hold out in practice. The other important point is, though, what I find different fundamentally is not the method you use, but the rigor with which you use it. So when you build a traditional scorecard, you have a rigorous process that you go through. And often the problem I see with machine learning is not machine learning. It's the fact that the users are not following the same rigorous process. I honestly believe that if you followed a rigorous process, not necessarily the same process, the value can be realized. I think there's a lot of cases, particularly in the collection space, where machine learning can add a lot of value. But again, it comes down to risk appetite and responsible use. Another important thing is in many cases where we've tested machine learning, the lift has been marginal over traditional methods. But what we have found is machine learning is often really good to accelerate the learning and the discovery of trends and patterns and insights. So for me, it's less about the technique and more about the rigor of the risk management process. I think both techniques are equally valid.
Yeah, and that brings up
Pravin made a comment to me in a private discussion, commenting about how for certain very large portfolios where people are looking for that little bit of extra lift, and they practically take the gloves off and throw in with the AI techniques. So if you are going to do that, to try to get the extra lift, just be aware of the risk.
Yeah, and this brings up another point is, you know, AI machine learning doesn't necessarily have to be the model that gets executed in production, right? It can still be used as kind of an exploratory tool, or perhaps even a validation tool for your models. So do you guys have any thoughts on, you know, AI and machine learning, its usage outside of being the production model running? Could it be used as a benchmark or for, you know, finding lift in other variables when you run it against the same training data set?
Definitely.
Mm-hmm.
So I have a problem with that starting point of a question, right?
Mm-hmm.
Why do you want to use a method that you don't want to put into production?
Exploration and understanding to sort of realize what's possible. And I think machine learning is being used in a lot of environments to just understand those environments. Then once you know what the factors are, some of it is exploration to find out just what factors are at play. Once you know what those factors are, you can build them into a simpler approach.
Yeah, I've seen it used, for example, as a feature creator. You know, you can apply a fairly automated, mindless technique to bring out the main dimensions. And then if you agree with those dimensions, you put them into a classic logistic regression or something. I've seen things like that.
So I agree with you, Alan. I think for me, the important part is to have your guiding principles up front. Is the model understandable? Are the risk drivers logical? Does the model generalize? Is it within risk appetite? If you meet those requirements, I have no problem using either a statistical model or a machine learning model. But if any one of them fail on any of the critical dimensions, I shouldn't use it anyway. But I agree with Alan, what you can do is build and more often we're seeing brute force type techniques where software will run a million different models and find insights. And then it's up to you to take those insights and validate them, I would say, before you use them. So again, it comes back not to the model per se, but to the process and the rigor of the process.
That's right.
By rigor, do you mean reproducibility here purely, or are there other things here as well?
So it's the entire normal model life cycle, right? So reproducibility for me is almost non-negotiable, and depends what you mean by reproducibility, because I suspect there's a few definitions there.
So somebody else being able to come up with the same results given the same inputs.
Yep. Yes, or at least the same ballpark of results, right? Because again, depends whether you've got seed variables in your algorithm or not, and whether your algorithm even allows for seed variables. But basically, most machine learning is numerical optimization as opposed to statistical optimization. In most cases, I'm generalizing a lot. And so for me, in terms of validation, it's, again, the transparency of the model. Do we believe it? Do we trust it? Does it generalize? Can we monitor it? What's the worst that can happen? And that's important. And what's the context where it's going to be used? Am I happy to use it there? Often you may face pushback regardless of being able to satisfy all of that, just because your auditors, regulators, or own internal risk management are quite conservative. But again, it's a process. If you can't convince your own internal validation team that machine learning models work, you shouldn't be using it anyway. It comes with trust. You should never use a model you don't trust. And it's up to you to prove the trust.
Mm-hmm. Yeah, understood. Raymond, Alan, Michelle, any other thoughts on AI machine learning? It's kind of
nothing further from me.
Alan, I know you had a question about the dynamic updating of scorecards. Did you want to ask that?
Yeah, but actually, I think the main part, the first part of the discussion has covered a lot of it. It's the idea that to be quicker and more adaptive in scorecard building seems to be the important trend. The question is, I mean, you mentioned earlier, Pravin, that the talk of recalibrating every month, and you mentioned as an aside, there would need to be a little bit of governance there every time. And I suppose my challenge is, does there need to be governance every time, or do we build an adaptive model which is governed once, maybe has some envelope in which it operates, and you can then manage that in a good, well-governed environment?
Well, that what you mentioned, an envelope within it, which it operates, so that is one part, but also speeding the governance process, because often the governance process is quite lengthy, what you have to go through with. The other aspect that I would see with an automated refresh, I mean, it's an ideal, it's a holy grail, but you could find that you're updating it using data to embed a trend, and that trend may have changed in the meantime because of the observation window that you're using within the data. That so that there's do with caution if there are fairly significant structural shifts that you are aware of.
So if I can add to that, Alan. So what I've seen more on the credit impairment side is a number of banks running automatic recalibration of their PDs, LGDs, EADs every month. But I've seen two patterns of usage of those parameters. One pattern is every month they allow the assumption to automatically update in the ECL, or the expected credit loss calculation. And another set would just look at them to see if it's changed a lot from the base period, and twice a year would go into a credit committee where they would decide to move it or not. So one bunch uses it to auto update and follow the trend and track the trend as Raymond indicates. And again, the base period there matters a lot. The other bunch use it almost for monitoring. For me, the more important part on either case is to create and calibrate over time triggers. Because again, whether you, and particularly with automated process, so I'm a big fan of faster, but I'm also a big fan of human in the loop. The problem is we're generating more and more statistics, almost to the point of too much. And so the one thing we have to do is calibrate swim lanes or guide rails that says, yes, we recalibrate, yes, we monitor, but we don't allow an automatic rerun of the model if something drifts out of that range, or we automatically take it to credit committee to update if it does go out of that range. So for me, creating those early warning indicators of change is more important than whether you automate or don't automate.
Mhm. Yeah, that's a big theme I've been noticing and seeing since the rise of the pandemic. Is I'll call this just my little theory here is the whole model risk domain was created to identify what kinds of model risks there are. With validation, we can understand why a model will break and under what circumstances. And I think, especially with the pandemic, the big question we're trying to answer now is when. When is this model going to break? When do I need to react? Because we have a solid understanding of what the risks are and how they will happen, but it's just a matter of when and trying to identify when.
Just to build on your answer, because that's a very good summary. There is no magic bullet. None of us know exactly what's going to happen. What's important is just to be sensible and to be sensible with a team, because we can't do it by ourselves.
Absolutely. I'm going to bring this. So Raymond, if you have a comment, I'm going to bring this here.
Well, you were mentioning about the internal versus external development. Were you going to bring that up still?
No, I think we're 5 minutes over, so I'll bring it to a close with one last question, which is, so Raymond and Pravin, where do you see credit scoring evolving in the next 5 to 10 years? In 5 to 10 years, kind of what does credit scoring look like, and what are the big differences from today?
To my mind, it's going to be the differing data sources that are going to be brought into the mix. There's a lot of stuff that we've been building upon over the past years. And when it started off with FICO and the crowd in St. Louis, there was a small loan lender. I mean, they were just using origination, application form data, and stuff off of a billing system. And over time, we've looked at bringing in transaction accounts, and you've got credit bureau who have amassed all of this data on payment performance. And sort of late, you're getting in utilities bills, rental histories, looking to psychometrics, although that tends to be frowned upon by many. The information that's collated off of mobile phones. And you still have people going out and doing personal interviews and making judgmental assessments of various bits that are going into an assessment, especially when you've got small business lending in emerging environments. So the statistical techniques sort of will evolve further, but I think those techniques that have been in play for a long time will still continue to play a large role. With the more avant-garde techniques, kind of taking the being front and center, where the potential losses, the governance issues are not as great. Pravin?
Yeah. So coming back to something I said earlier, the more things change, the more they stay the same. I see us having a lot more shinier toys, fancier models, faster data streams, more data, all of those things. But fundamentally, we're going to be given scores, points, measures, and we're going to have to make a decision. And I think lenders are going to fall into mostly two camps, the lazy camp and the innovative camp. And the third camp, which is the reckless camp. The reckless guys will eventually go out of business. But the innovative and the lazy guys will just follow, let the AI do the work, kind of bank your model or move ahead. Hopefully we don't go bust one day. And hopefully over a 50-year time period, you won't. You make money just because of your size. The innovative bunch, though, will be a lot more circumspect about how they examine the shiny toys, how they use their shiny toys. And I think they will run rings around their competitors. So I do see a lot more carve up of the market into niche boutique players. But I also see where we've had the Googles and the Amazons and the big IT companies. I do think certain companies who become really good at insight and execution of insight, because without the ability to execute, insight is pointless, will run the opportunity of running rings around competitors and creaming huge amounts of market, which in itself presents systemic risk.
Mm-hmm.
Just another comment on the data front. I think something we've been used to sort of being, as a model developer, I've been used to being presented with a set of data, and you have to work with that data, and you haven't got much flexibility to play around. And what will be coming more and more is the ability to manipulate the data to come up with alternative features. Alan was mentioning about the feature engineering. Even within the larger organizations that have had historically have been quite restricted in what they could do. There's now software that gives them greater flexibility to design their own features. And test them, actually do some form of testing to see just how does this work. So again, relating to kind of what data is available and what do you do with it.
Yeah, those are both really, really fascinating on kind of what the future might look like for credit scoring and credit decisioning in the future. So with that said,
just one thing I would like to, before we sign off, if everybody has time, just to have some feedback, especially from Alan and Michelle, because sort of it's been you and myself and Pravin who have sort of been kind of trying to put this together. Just some feedback about this. Now, whether this is part of the recording or not, I think it would be valuable to have it as a part of the recording. And this is a biased sample because you're
part of our focus group now.
Alan?
I mean, I've enjoyed the discussion very much indeed. I mean, I'm obviously very much interested in the topic, and I think there's a lot of good ground covered. I mean, literally, I don't. By working in the bank, or I'm working on sabbatical at the moment as well. These sorts of forums are a breath of fresh air. They're my oxygen that keep going. So it's very much appreciated to discuss this.
And Michelle?
Oh, yeah, thanks for all your comments, and Pravin, thanks for letting me give you a hard time.
You're welcome.
I'm pleased that your comments, they do track with what we're seeing in the industry. They track with how, when we're working with banks, lenders, fintechs around the world. So this just gives us even more kind of strength in our position in terms of how we guide banks when we do workshops with them, et cetera. So yeah, and you had a couple of more subtle comments, which are extremely helpful. So I appreciate those just from the depth of all your experience. So thanks a lot for that.
Oh, you're welcome. And thanks for the questions.
Excellent. So if we host one of these again, Alan and Michelle, will you guys be tuning in again?
Yes.
Absolutely. And I would probably drag some of our colleagues into it as well.
Yes, please.
Likewise.
Great. Well, thanks for organizing it. I really appreciate it.
Yeah, not a problem. Not a problem.
Thank you.
All right. So hopefully this will be the first of many. And Raymond and Pravin, we can circle back and see if we want to hold one of these in a few months again.
Whatever, I'd be happy to. It might just be in a different venue. It's probably still going to be dark outside. One of the comments that I was looking at, sort of where everybody is. And Alan, you're in Edinburgh, and the sun is low in the sky. It's earlier than the day in the day than here, about 4 p.m., 5 p.m.
It's now approaching 6 p.m., but the sun is still quite high. Remember, it's Scottish summer. Although not quite
Yeah,
midnight. sun,
okay, well, with those shadows, it's high for Scotland.
yeah.
The shadows are still light. And sort of, Michelle, you're kind of midday somewhere. But here I am, sort of like everything's dark outside.
That's correct. Midday over here. So we'll see what time zone comes next time.
Okay, Mark, I think you want to do the sign off.
All right. All right. Well, thank you everyone for attending. We really appreciate the good conversations that we've had here today, and look forward to seeing you guys next time. Keep an eye out for the recording. It will be shared among members. And to everyone, we'll see you next time.
Thank you. Take care, everyone.
Yeah.
Bye.
Thank you.